huge changes are coming to credit scores. So you want to stay tuned for this. What's up, winners? My name is Naam. If you're new to the channel, welcome. Here we talk all things personal finance and credit. Start now by subscribing so you don't miss out on any future videos. The first of many changes is that the three national credit reporting agencies, which is Equifax, Experian, and TransUnion, have extended their free weekly reports until December 31st of 2022. Originally, before the pandemic and everything that was going on in the world, you were only allowed to request one credit report once a year. So the only way you can get free annual credit reports is by visiting annualcreditreport.com. As a reminder, credit reports are different from credit scores. Credit scores is just an algorithm that determines your credit worthiness depending on your history. Your credit report is just what it sounds like. It's your history within the past 7 to 10 years that you made with lenders. Initially, this program was set to expire in April 2022, but has recently been extended to the end of this year. So why is this even important? The reason why you want to check your credit report often is that your report shows you how many credit cards and loans that you have, whether or not you paid your bills on time, and whether or not you have any debts that turned over to collections. This is important because creditors, some employers, and even other businesses may pull your credit report before even doing business with you. It also determines your terms and your interest rates. So if incorrect information such as delinquencies, late payments, charge-offs, and even bankruptcies that aren't yours hurt your credit and increase how much it would cost for you to borrow money. Let alone, it definitely does hurt your chances of even getting a loan, insurance, a rental, or even possibly a job. So the sooner that you can spot a mistake, the sooner that you can dispute the error. Moving on to the next major change, which is how medical debts are being reported. It was reported by the three major credit bureaus that they will strip 70% of all medical debt information out of consumer credit reports starting July 2022. These credit bureaus, they also said that medical collection debt will no longer appear on your credit report where the debt has already been paid. Meaning that if you have a medical collections that have a zero balance, these will now be reported and no longer affect you negatively on your credit. They are also increasing the length of time that the debt will appear on your credit report. Originally, it takes 6 months for medical debt to report, but now they're increasing that time to 12 months. They also mentioned that sometime in the first half of next year, which is 2023, they will remove unpaid medical collections from your reports if it is less than $500. The reason on why this came about is that one of the big government agencies, which is the Consumer Financial Protection Bureau, has considering a ban on medical debt. The CFPB found that 43 million credit reports contain medical collections, and in the second quarter of 2021, 58 of those bills and collections are medical bills. And it is also reported that nearly 1 in 10 Americans carry medical debt over $250. That's a lot of people out there, which is pretty crazy to even think about. I'm not sure if you've seen this viral video about a mom who recently showed her hospital bill after giving birth to a child. But if you haven't, it goes something like this. She just had her second baby and she showed a bill for a natural delivery with a one-night stay at a hospital. It showed that the final cost was around $36,000. Of that amount, she had to pay $2,200 after insurance paid their portion. So imagine living in a country where it can be extremely difficult for the middle class or even low income people to pay for that. Also, medical debt is one of the leading causes of bankruptcy. So as you can see, medical debt is what damages people financially the most. So how would this exactly change your credit score? There are already newer scoring models that don't factor in medical debt or pay medical collections, but the majority of creditors and lenders out there are still using older models such as FICO 8. So based on my research, it doesn't say whether or not they're gonna backtrack all of the FICO scores or only if this applies to the newer ones, but based on the information that I gathered, I believe this is for all FICO scores. With this information removed, this would definitely help a lot of people out there and help increase their score. So before moving on to our next change, I would like to thank today's sponsor, Bankrate. You can get pre-qualified for a loan offer up to $100,000 in just 2 minutes or less. All you gotta do is answer a few questions, compare your offers, and then just lock in your rate. Whenever you pre-qualify, this will not affect your credit score. So if you wanna know how much you can pre-qualify for, there's an affiliate link down in the description. Now let's talk about another change that will be coming to your credit report, which is buy now, pay later loans. So some of the major companies that you might have seen during checkout when you're shopping online could be from Affirm or Klarna. There has been a huge rise of these companies when shopping online due to the pandemic, but the thing about these short-term loans is that unlike credit cards, some of them do not report to the credit bureaus. So there are a lot of subprime borrowers out there that are taking out these services and their credit scores are usually not affected if they're not making on-time payments, which can be a good thing for them since they do get the things that they want, but also puts them in a worse position with debt. This also depends on the length of the loan. Sometimes if the loan is only a couple of months or 0% APR, then they may not report it, but if it's longer with terms, then they may. But in recent news, the major credit bureaus are pushing more for these buy now, pay later companies to report them. So how does reporting these loans affect your credit score? One of the biggest things is the amounts owed portion of your credit score. Anytime that you have more debt, this tends to hurt your credit. Also, since this is an installment line of credit, if you were to miss any payments, this can really affect your payment history. Generally, whenever you open up a new loan, this tends to drop your credit score by a few points. But as your balance becomes lower and lower, your credit score begins to increase. But once you paid off the loan, this removes the trade line. So this can also negatively impact your credit score, meaning that your credit score will not go back to its highest peak until a few months or unless you get another loan and begin to lower its balance. Credit scores are weird, I know, but you get rewarded to remain in debt. Each credit bureau has different plans on how they want to report this information. For instance, TransUnion is attempting to address this issue, but not counting all of these loans in the calculation. Instead, they will be reported on your credit report, but not affect your credit score. As for Experian, they're doing pretty much the same thing as TransUnion, which means that they'll collect all the loans currently and your outstanding debts, but they will not be using that to factor in your credit score, at least for now. On the other hand, Equifax is going to be doing something different compared to the other two. Equifax will allow these buy now, pay later providers to include these loans in the calculation of your credit score. So long story short, TransUnion and Experian are not currently factoring these loans, while Equifax possibly can. It really just depends on how the provider reports the information and whether or not the company pulling your credit is going to be using those loans into consideration. So I understand that this can be a little bit confusing because some of these buy now, pay later loan providers may or may not report certain loans to the credit bureaus, and additionally, the credit bureaus may or may not use this information against you. So if you do see an affirmed loan on your credit report, it possibly is not factored in. The key thing about these type of loans is that I would always treat them as any other type of loan that you would get from a bank. Because if you were to miss a payment, this will most likely have a negative impact to your credit score, and the likelihood of you getting another short-term loan might be more difficult. So even though some of these loans may not be reported or factored into your score, I would just treat them as any other loan. So now let's move on to the newest type of credit scoring model, which is the FICO 10 and 10T. These scoring models were introduced back in 2020, so you may start to see these used more frequently. One of the major key differences between 10 and 10T is that the T version looks at the previous 24 months of credit activity to predict future behavior. The reason why there are two different types of FICO 10s is because FICO can sell these scores depending on what the lenders want to know. But as of right now, most lenders still use FICO 8 for their lending decisions, and this credit score was actually introduced back in 2009. For mortgages, they still use FICO 2, 4, and 5, and auto lenders, they have their own FICO scoring models. But a lot of lenders are using a combination of different FICO scores to determine whether or not they want to approve you for lending. Now, whenever FICO 10 becomes more widely adopted, how is this going to affect your credit score? Your score is most likely to drop with FICO 10 if you took out a personal loan to consolidate your credit card bills, but your credit card balances are up again, or it appears that you apply for more lines of credit. Another reason is that if you're using credit cards regularly, but the balances are not being lowered or they're continuing to grow, this will negatively impact you. And lastly, if you miss the payment, late payments will be punished more heavier than previous FICO scoring models. So to keep your credit score as high as possible for FICO 10 and 10T is to make sure that you pay your balances on your credit cards as low as possible. Having consistently high balances or rising balances can show that you're in a financial pickle. And just like any other scoring model, you want to avoid missing payments. So there you guys have it. These are the upcoming changes that are coming to your credit score. If you guys want to hang out with me some more and learn more about building credit, check out these videos over here. I'll see you over there.